Professor, if you're speaking, I don't think I could hear you.
Sorry, I didn't have my button on. Excuse me. Thank you. Sometimes I forget about that. So again, I'll start again. Good evening, everybody. Welcome to week 6 of our spring term. We've completed the midterm, and now we're moving on now to more of a managerial accounting study. Tonight we're talking about controlling assets. The two major assets of liquidity are cash and accounts receivable. We're going to be learning a little bit about that this evening. I'm going to do a little bit lower profile tonight. I know a lot of you worked hard on that midterm and are still working on it. So I'm going to take a little bit of it easy tonight. There's no graded work this week. The only thing I need you to do is to, especially Ms. Ramos, I still need a company from you for your project paper. I do not see that listed in our discussion forum. So if you could, in the next day or so, post to that discussion forum a company that you have selected to do your project paper.
You got it, Professor.
I'm sorry?
I said you got it. Since I told you during our interview, I forgot to put it on Blackboard, but I'll do that tonight.
Perfect. I need to see that. Thank you. So once I get everybody's companies, I'm going to be putting together a little information piece on how you go about researching and doing the 10K. I have posted this afternoon to our Blackboard, to the project paper file folder, a sample paper that you can download and see how a student in the past has done this work. Give you an idea, and I'll go over that project paper sample next week in class. So you might want to take a look at that to help you get prepared for that paper, which is due the last class in May. I will not be reviewing the midterm review because some of our students have requested extensions and have not finished the work yet. Once they finish, I'll be putting together a video reviewing the midterm, and I'll probably post that video Friday or Saturday of the coming week, so you can review your answers and get your grade reviews and the solutions in Blackboard. So that midterm review will be once we all get our posting of the work done, and then I'll do a little video to post to Blackboard so you can review that. Remember, all our classes are being recorded. There are links in the Blackboard, or you can go directly to our YouTube playlist for Accounting 203 500A spring term and see those videos and sample videos of any work, any related topics currently on our calendar. So take advantage of that to review the class lectures at our YouTube site. Before I get to begin the evening, does anybody have any questions or concerns or anything I need to go over administratively before we start? Okay, that was easy. All right, well, let me load this up and get started. I'm going to let you guys leave a little earlier tonight than usual, which I'm sure a lot of you will be totally upset with. But we're going to do a couple problems. We're going to talk about tonight controls. You know, a lot of you in your own personal finances, it's always important to know how much money you got. Or it's always important if somebody owes you money, like a homeboy or a homegirl or your family member. If somebody owes you money, that's important to keep track of, all right? It's called the internal control system. Always knowing where your liquid money is, where your cash is. That's key, especially in times of when cash is tight. That's what Chapter 8 is about. To protect assets, to ensure ethics and reliability, to uphold companies' policies and ethics. You know, a lot of people don't do business with companies if they think they're unethical. for whatever reason. And if a company keeps having lawsuits or firing people because they're mismanaging their assets, a lot of people won't do business with them. A lot of investors will not invest in them. So to control your money, to control your receivables, shows the world, shows your investors, shows your employees, hey, we know what we're doing. We're efficient. We're ethical. That's important, especially in business. Also, it promotes efficiency. Geez, if you know how to manage your cash and manage your receivables, you must manage other things just as well. It sends a picture to the world that you're in control. And it's called the managerial function of a business. I'm efficient. I'm in control. So this is what we're talking about. Also, it goes back to ethics. You know, a few years ago, we had a lot of troubles, a lot of ethical concerns in the market and industry. Enron, for one. A lot of companies did things illegally. British Petroleum polluted the Gulf of Mexico. Very poor controls. So the United States Congress passed a law called SOX, Sarbanes-Oxley Act. It gives the responsibility to managers and auditors. If they don't verify a company is doing things the right way, they can be thrown in jail. They can be sued. That companies have to fulfill ethical guidelines in order to run their business. Sarbanes-Oxley, SOX. If companies don't do it right, they can be thrown in jail. They can be sued. And that's an important law that was passed about 10 years ago to make sure investors, consumers, employees are managed correctly. The principles of internal control are just like, maybe I shouldn't say this, but just like managing your own household. Establish responsibilities. Certain people have responsibilities. Everybody does their job. There won't be any problems. Problem with running a family, because I raised 2 children. Thank God they ended up fairly normal. And thank God they're out of the house and I don't see them anymore. Adios. See you later. Get out of here. I shouldn't say that. My wife is listening. But at the same time, they're no longer costing me anything. They're adults. They're in their 20s. They're now beginning to raise families. They're establishing responsibility. You maintain adequate records. Tonight, we're going to be doing one big, very important piece of maintaining adequate records for a company, and that's the reconciliation of cash. You make sure you ensure that assets are protected. Employees know the responsibilities that they must do. Naturally, the higher you go up the food chain in a company, the more responsibilities, the more subject to analysis. But everybody in a business has responsibility. You have separate record keeping of assets. You keep track of cash. You keep track of receivables, as we'll see tonight. Yes, we keep a general ledger. You've done that already of cash and accounts receivable. But also you keep sub-ledgers of reconciling cash on a monthly basis. A sub-ledger of what are the details of who owes you money. As we'll look next week in chapter 11 of who you owe money to. And as we look in chapter 10 next week, what are the fixed assets or the physical assets that we own? We need to keep track of them. And as a manager of this control, you need to keep responsibility. Who's in charge of what? You apply technology to the management of this. More and more these days, computers run the show behind the scenes of financial operations of businesses. And above all else, you hire CPA firms to perform regular and independent reviews of your business. You will not be allowed to be in business if you're a publicly owned corporation if you do not have a third party come in and review your books. A public accounting firm, a CPA. Without that, companies cannot be in business. Simple as that. The reason why we have all these internal controls is to use technology to limit fraud and have internal control. I'll tell you a story. I don't like saying it, but it's true. About 12 years ago in my business, I found out that somebody took money from me. Embezzlement. It was a small amount of money, really, $1,200. Can I tell you this? Yeah, I can tell you this. $1,200. They took money from me, $1,200. Well, $1,200, all right, you're going to probably fire them, maybe ask them to pay your money back. But I was in the investment business. People gave me their money under the auspices that I was trustworthy. I was a good manager. I had to set an example to my other employees and to my investors, to my customers, to my clients, to my bankers, that I was in charge and making sure that this would never happen again. So I had to arrest this person for embezzling $1,200. I had to prosecute this person because I had to show the world that this wouldn't happen again. Because if I let this go on or let this person off with a slap on the wrist, what would prompt somebody else from doing this? I had to set an example as an investor, an investment business. So the person went to jail. Their business life ended. Now, subsequently, long story short, the person was released from jail after 4 years and now is doing something else. And I'm not saying that I'm the greatest forgiver in the world, but I helped this person find another job in another business, another line of work. They drive a truck. They don't keep accounting records anymore, but they're back on their feet. But the point of internal control is to make sure you set an example of how you run your business. Every day you read in a newspaper about embezzlement, fraud, companies breaking the law. This can't exist. And this process of making sure that this cannot happen has to be individual within a company. It's very important. A lot of us, when we get a new job now with a company, we do a background check. Sometimes you're a little bit scared of that because you never know what background checks will tell you. Geez, will I not get a job because I got a traffic ticket outstanding? Or will I not get a job because at one point in my life, I bounced a check? No. If the company has any class, that would be a big deal. But they have to make sure for their own internal controls that you don't have a history of breaking the law, felony charges, maybe violence. They're not going to hire you. It's too much of a risk. So this is part of the ethics of accounting, making sure you have controls and manage your affairs wisely. Kind of sad, but it's true. And the first step of that is controlling cash. When a record of cash coming in, a record of cash going out, receipts, canceled checks, invoices, all these things you have to keep as proof that you're basically accounting for it properly. The 3 basic guidelines to controlling cash. Handling cash in a separate record keeping. You have a cash account. Cash receipts are promptly deposited into a bank. And cash disbursements are made by check. You don't want to pay your bills in cash. Only if your last name is Don Corleone. You guys probably didn't get that. But you want to have a receipt, and the receipt is the canceled check. You want to make sure whoever you're paying gets paid and they cash it. So this is called cash management. The record keeping of cash. And just like in your own personal life, I think it's probably most of you could probably say tonight, you kind of know how much money you got. Like me, you're probably embarrassed to tell anybody because I don't have much money. But I'm sure today, at this present hour, you kind of know how much money you have available in your bank account. You kind of know probably how much money you have in your purse, in your wallet. Because why? You need to know that in order to manage your family affairs. So cash management is one of the most important internal controls a company can do. That's why I'm spending a little bit of time on it tonight. It's very important. You have to keep track. A sales department sells your product. A cashier records the cash and deposits it. You have receipts. Those receipts are backup to the deposits made in a bank. You keep track of it. If any of you are in retail, what's one of the biggest things you do every day? You balance your cash register drawer. Does my cash, what I brought in, plus what I started out with, does it match the receipts of the sales I made during the day? And if it's off, somebody has to account for it. Well, sometimes minor errors of 50 cents or $1 or $2 is let go. That's not a big deal. But if your cash drawer is off 50 bucks, as a manager, you want to know, all right, where's that 50 bucks? Is it in somebody's pocket? Did somebody say they paid us and they didn't? Where's the receipt? So the record keeping of cash is huge, especially in businesses that require a lot of cash payments. Now, this is becoming a dwindling thing, as you all know, with credit cards, debit cards. I don't think, I'm trying to remember when's the last time I paid cash for anything. Everybody uses debit. Most of our bills are paid directly out of our bank account. Today, I did Uber Eats for the first time of this quarantine. I did Uber Eats. I ordered a sandwich for my wife and I from Jersey Mike's, if anybody knows what Jersey Mike's is. And for the first time, I felt kind of guilty. I'm like, Jesus. But I said, all right, I'm going to try it today. So Uber Eats delivered lunch to us at our house. 2 submarine sandwiches. Never saw money. Put it on my debit card. Tipped the driver. Lunch was served. So we don't use cash anymore. But at the same time, you have to account for the credit card transactions. There's receipts. The use of credit. That's an important thing to manage. You also have to control your cash payments. Many of us work for companies that have accounts payable departments or cash disbursement departments. You do a purchase requisition, a receipt of a bill, you give it to somebody, they cut a check, and they mail it out. Those cash payments, the check is the receipt. That's why most businesses pay in with checks. Now, wait a minute, Mr. Hassey. What about payroll and direct deposit? Direct deposit is like writing a check. There's physically a digital check made to you that's deposited into your bank account. Now, naturally, you don't see the check, but sometimes if you go and get a receipt of that paycheck, it'll be in the form of a check that was deposited into your bank account. There is technically a check made when you have direct deposit of your payroll. So dispersing those checks, dispersing cash is very important. They have to be a proper backup to that. And does the payment of the funds match a budget? Did you plan on doing this? Did you plan on spending this money? And if not, why are you spending it? I'm not going to spend much time on petty cash because petty cash is like a couple of $100 you keep in your office and you use it to pay bills with cash when people come into the office. But petty cash is a system of control of cash where you have a set amount of money set aside, and that set amount of money is then used to pay bills. The receipts that you have reimburse the petty cash, and then you keep the amount of money accounted for in your company. Petty cash. But I don't want to spend too much time on that because a lot of companies don't have much petty cash anymore. That's becoming non-existent. But the big thing that we're going to talk about is dealing with banks. Banks are a third party to us. We have our cash account, but also we have a bank account. That bank account should pretty much mirror our cash account. We deposit cash, debit cash, that's a deposit to the bank. We write a check, credit cash. We write a check, the check clears the bank. The bank is like a CPA firm. They're a third party for our cash transactions. There's a lot of things going on in a bank account. Not only deposits and checks, there's bank fees. Many companies pay bills out of their bank account directly without cutting a check. Many companies get money wired into them as payments. We have to make sure we reconcile all this money. I ran a very small business, 19 employees. But the amount of cash that went through our bank accounts on a monthly basis totaled tens of thousands of dollars. You have to keep track of that. And when you think about if you get paid from a direct deposit from your company, most of us get paid maybe what, $3,000, $4,000, $5,000, $6,000 a month. That's $72,000, $50,000, $60,000 a year in deposits. We should make sure we keep track of all that money. That's why we reconcile our bank accounts. Are we managing that money? We have to keep track of that. So this is what banking or bank reconciliations is are we reconciling our cash ledger to the bank? We match up deposit tickets. We match up checks. And we get our bank statement. The bank statement is these deposits and checks clearing, and so we reconcile that to our cash ledger. Again, I go back to my point at the beginning of our class. If we don't do this, our investors, our employees, our managers will not trust that we know what we're doing if we don't reconcile this. How can you run a business if you don't know how much cash you have? How can you run a business if you're not accounting for any discrepancies between the bank and your cash ledger account? That's reconciling cash, reconciling your bank. Can you imagine reconciling the bank account of Walmart? I looked it up. Walmart on a monthly basis has roughly about $800 million going through their bank account. 800 million. Checks, deposits, transfers. And somebody, I should say, some department has to manage this, has to reconcile this. Why? Because Walmart has to show in their 10K, something that you guys will see when you do your project paper, the 10K, and tell the government, tell investors that yes, our accounts are balanced. We know what we're doing. So let's prepare a bank reconciliation. The purpose of a bank reconciliation is to balance the cash in the bank to the cash in your general ledger. To balance those, they come out equal. Things that occur on your bank statement must match the things that occur in your cash general ledger, and vice versa. If they don't, they're called reconciling items. What's a reconciling item? An outstanding check. A check that you have credited cash but has yet to clear the bank. What is a reconciling item? Deposits you have made to the bank, to your cash account, but the bank has yet to clear them. What are reconciling items? Bank fees and bad checks that you only find about through your bank statement. And also errors that you might make. You're reconciling, so at the end of this reconciliation process every month, your accounts balance. Here's an example of a reconciliation, and we're going to do one in a few minutes. Let me make this bigger. Hang on. There we go. Isn't technology wonderful? Here's a company called Video Buster. I bet you they're no longer in business. Here's a company called Video Buster. Notice on October 31, 2019, they have a bank statement balance of $2,050. And notice on October 31, 2019, in their general ledger account, their cash book balance is $1,405. How can we have $2,050 in our bank, but only $1,405 in our cash ledger account? That's why we reconcile. Notice the bottom line, $1,845. They reconcile. Why do they reconcile? We take events that occur on one side, the book, or events that occur on one side, the bank balance, and match them. Anything you adjust to the book balance here, this is important. This is where I'll get you on the exam. This is where I'll get you on a quiz next week. The important thing is, if it appears on the bank, but is yet to appear in your ledger, you have to make sure you do an adjusting journal entry. An adjusting journal entry. You do not correct anything here on the bank reconciliation on your bank statement side, because those eventually will clear the bank probably in the next month, November. But if you make adjustments to your cash account per the bank statement, you have to do an adjusting journal entry. So we're not going to be doing many journal entries anymore. We're going to do some in Chapter 9 as well. But the adjusting entry will have to be done for any adjustments to cash per the bank reconciliation. Okay, well, let's do one. I'm looking at your textbook. On page 318. 318 of your textbook. Problem 8.4a. Preparing a bank reconciliation and recording the adjustments. We're going to do exactly what we just saw on that slide. We're going to reconcile our bank account. So I've created a spreadsheet. Here it is right here. And we're going to reconcile this, and then I'm going to post this to the spreadsheet to our Blackboard file in week number 6. We're going to have a quiz next week, I think. Yes. We're going to have a quiz next week, and that quiz will be on this very subject, plus a couple other items that I'll tell you later. Reconciling the bank to our cash ledger, a part of internal control that we need to know. Not so much that you'll probably never do a bank reconciliation for a company, but to understand the importance of making sure you are controlling and being efficient in the management of your cash. So if I look at page 318, it talks about a company called the Branch Company. And on July 31st, they have a bank statement balance of $27,233. $27,233. The cash general ledger on July 31st has a balance of $27,497. We're a little off. Why are we off? We have to do a reconciliation. So now we go through the information provided in this problem and make sure we account for, either on the bank statement side or the cash account or ledger side, and reconcile these two amounts so they equal. The answer is $34,602. But let's see if we can do that. Transaction or letter B in that problem. Check number 3031 for $1,482. Check number 3065 for $382. And check number 3069 for $2,281 are all outstanding as of July 31st. What does that mean? It means we have wrote the checks, we've credited cash, but they have yet to clear the bank. All right? So we have to deduct that from the bank statement balance. They have yet to clear the bank. So we deduct checks number 3031 for $1,482. Make this a little bigger here. Check number 3065 for $382. And check number, now in the real world, this is all done by computers, $2,281. All right, what is that total? $4,145. And we're going to subtract that from the bank statement balance. $4,145 is the total amount of our outstanding checks, and we're subtracting that from our bank statement. Why? They have yet to clear the bank. When they come in, maybe on August 2nd, these will be deducted from the bank statement balance. So that's a deduction as a cash bank statement reconciliation. Transaction C. Check number 3056 for July rent expense was correctly written and drawn for $1,270, but it was erroneously entered in the accounting records as $1,250. So we recorded it as a $1,250 check, but it was actually for $1,270. We have to deduct for the bank error, for our error. The bank doesn't need to, we don't need to deduct it from the bank. We need to adjust our account. Error, check number 3056. That's a deduction of $20. We made an error, so we have to deduct $20 more from our cash account, and we have to do that in a form of a journal entry. That in a little bit later. Transaction D. The July bank statement showed that the bank had collected $7,955 cash on a note for Branch. Branch had not recorded the event before receiving the statement. So they found on their bank statement that they had a deposit made, or the bank collected from us. So we're going to have to add that, and we call it note collection. Right much? Note collection. And we're going to add that amount of $7,955 to our bank cash account, because we found out the bank collected it for it, we now have to adjust our cash account for that note being collected. We have to do a journal entry for it. Transaction E. I remember this from the days when I used to run my business. The bank statement shows an $805 NSF check. The check had been received from a customer, Evan Shaw, and branch has not yet recorded this check as NSF. What is NSF? Non-sufficient funds. El Bounco. A bad check. Right? So we now still have to collect that $805 from Mr. Shaw. And that's going to be, we have to put that back on our books as a accounts receivable. But also we have to deduct it from our bank, from our cash account, because we probably deposited his check as a debit for $805. And now we find out that it is non-sufficient. And that's going to be a negative or a credit to cash of $805. NSF check, bad check. The good thing today about modern banking is you pretty well know when somebody deposits a check that it's good right away. But there's still some times where checks that are written out of state or through multiple bank accounts that are far away, sometimes it takes a while to determine whether that check is bad, and the bank statement will give you that information. Transaction F. The July statement shows a $25 bank service charge. I'm sure you're all familiar with bank service charges. Bastards. It has not yet been recorded in miscellaneous expenses because no previous notification was received. So we're going to have to deduct that service charge from our cash account for bank service charges for their little fee for managing our account. And that's another deduction from cash that we have to do a journal entry. Transaction G. Branch July 31st daily cash receipts of $11,514 were placed in the bank's night depository on that date, but do not appear on the July 31st bank statement. This happens a lot, especially when I was doing business. At the end of the day, you get all your cash, your checks, you go over to the bank. Many times banks close at 5, 6 o'clock. So what do you do with that deposit? You put it in a bank depository, a little chute, and it's credited the next day. But as of July 31st, you do not have access to those funds. So that means you've deposited or debited cash account. Now you have to include it as a reconciliation and add to your bank statement. Those are called deposits in transit. You've collected the money, you've deposited into your cash general ledger, but the bank has yet to credit the account. $11,514. Deposits in transit, DIT. So let's see we're good accountants here. Let's now total up these balances and see what it looks like. All right, 27,233 plus the negative 4,145 plus the positive 11,514, we get $34,602. Let's see what the cash ledger looks like. You got the beginning balance, 27,497. We deduct the negatives plus $20, 805, 25, and we add in the note collection, and golly gomer, we reconcile. we have now balanced our general ledger cash account to our bank statement. Look at the balances. They're a lot different than what we started out with because of all these adjustments to the bank for things that have already occurred in our cash account, and all these things we're adjusting cash to things that occurred on our bank statement. But in the long run, they now equal. So now we have to do, as I said earlier, we have to do adjusting entries to our cash account because of these transactions. So I do a little adjusting journal page here. And the date will always be July 31 for each transaction. So let's record the note collection. And let's record the items that occur here. All right. For example, looking back on the note collection, we had a $7,955 collection of a note. All right. So we received cash, debit, $7,955. Make that in cash. And we credit notes receivable. $7,955. Because we're wiping out the note because they paid us. Credit the notes receivable. Next transaction. Let's record the bad check. Somebody wrote us a bad check, so they still owe us the money. Accounts receivable. Debit, $805. And credit cash. Taking it out of the cash ledger because it was a bad check, $805. So we're adjusting the cash account for these transactions on our reconciliation. Let's record the error in the check number 3056. Again, July 31. And remember, this was for an adjustment to a check that we wrote, where we wrote a check for $1,270, but we recorded as $1,250, and it was for, I believe, rent expense. We debit that account, $20. And we credit cash. Adjusting our cash for that error we did where we posted the amount incorrect. And finally, let's record the miscellaneous or bank service fee, the bank charge. I think the province calls that a miscellaneous expense. So we're going to debit for that bank service charge of $25. And we credit cash, $25. And now we have adjusted all the bank reconciliation adjustments. And if we post these to the general ledger, the cash account will be $34,602 at the end of July. And then the bank statement, once these checks clear, hopefully in August, and this deposit is probably posted on August 1st, they will have a $34,602. So we have now reconciled our cash account. You can imagine how complicated this gets for major American corporations, but again, computers and all that does that. But that's something that we have to make sure we know how to do, and what's the meaning of it. The meaning of it is a lot more than the kind of relatively ease of the transactions or the reconciliation. because if we don't do this, we're not ethically controlling, being efficient reconciliation of our major asset account called cash. And this is problem 8-4 on page 318 of your textbook. Next week on our quiz, you will have to do a reconciliation just like this. Reconcile the bank to the cash account, and then prepare the necessary adjusting entries to adjust the cash account for that activity. That's what you need to know from chapter 8. And the reason why you need to know how to do it, because again, as I was saying, it's an important part of telling the outside world you're on top of running your business. You're efficient. You know where every penny goes. If somebody's lending you money, if somebody's buying your stock, investing in your company, and you don't reconcile cash, that doesn't set a very good example of what you're doing with their money. When I borrowed money from banks, every month I had to give them a cash reconciliation to prove to them that I knew what I was doing with my cash. It's part of doing business. Chapter 8, controlling cash. So let's take a break. When we come back, we're going to talk about controlling accounts receivable. Chapter 9, controlling accounts receivable. Just as important of cash, because you don't want to make sure that there's no deadbeats out there for your company. You collect your money. And if you don't collect it, why are not you collecting it? They don't like the services they were provided, so they're not paying you. Or you're inefficient in the collection of making payments, of collecting payments. So when we come back from break, we're going to take a look at Chapter 9, Accounting for Receivables. So I'll see you back here in about 10 minutes, a little bit after 7 o'clock. See you then. Thanks, everybody. Okay, we're back. About an hour to go. Just to confirm with everybody, I have Kathy selecting United Health Group for their project paper. I have Barbara picking Amazon. I have Victoria picking Apple computer.
Yes.
Thank you. And I have Marianne selecting Home Depot. And Gabriella, you said you posted yours, and I haven't seen that yet. And Vince is not here tonight. By the way, Vince broke his ankle. If anyone knows Vince, Vince is one of our class members, and he broke his ankle this past weekend and is a little bit under the weather and is not attending our class this evening. He's going to be okay. He will be back next week. But Vince had a little bit of an injury over the weekend, but he's okay. All right. Let's proceed to Chapter 9. Chapter 9 is similar to Chapter 8, is that we're making sure we understand about a certain asset, controlling an asset. In this case, in Chapter 8, it was cash. In Chapter 9, it's accounts receivable. And we all know how this works. Here's an example on your screen in front of you. On July 1, TechCom had a credit sale of $950 to Comp Store and a collection of $720 from RDA for a prior credit sale. So these are two examples of recording a credit sale. You make the sale and you give somebody an invoice, debit, receivable, credit sale, and then somebody pays you for amount they owe you, an invoice, debit, cash, credit, accounts receivable. Right? Now, the thing we have to remember though, and that's the purpose of this chapter, is that many times when we sell somebody on credit, they don't pay. Or they take a while to pay, more than 30 days. So because of that, we need to keep track of all that. And also what's just as important is what point in time do we A, send that unpaid invoice to collection, or B, at one point in time do we write off the sale? Write it off. And that is called a bad debt expense. You still record it as a sale, but maybe 3 months later, you write off that sale, but you don't debit sales, you debit an expense account called bad debt expense. When do you do that? And that's one of the efficiency or the management techniques or the management of receivables. How long do we try to collect, and at what point in time do we write it off? This is a big deal. Because why? Most companies have a budget amount for bad debt. They anticipate what their bad debts are going to be every year. They know they're never going to collect 100% of their receivable. Boy, can I account for that. Most businesses usually collect about 92 to 95% of their receivables. The rest are deemed uncollectible for a variety of reasons. Reason one, they don't like your product, so we're not going to pay you. Reason two, they died or went out of business. Reason three, they're just being morons and making life difficult. That's true. But whatever the reason, many times you never collect your receivables. And we have to write them off. That's what Chapter 9 is when and how is the procedure to account for receivables and when do we write them off. So many times companies keep what is called a receivable ledger, a listing of all the people who owe you money. Credit cards are a form of receivable. It takes usually, it depends on the credit card agency, American Express, Visa, MasterCard, Discovery, whoever. It usually takes $24 to $48 to collect that receivable from the credit card agency. And when they do send you the money, they take a fee out of it. A fee. Anywhere from 1.5% to 5% of fee out of a collection. Here's an example. On July 15th, TechCom had a $100 credit card sale with a 4% fee. Sounds like American Express. And it's $96 cash is received and immediately deposited in the bank. Debit cash, $96. Credit or debit credit card expense, that's an expense account. And credit the sale. You still sold $100. You only got 96 bucks. The credit card company kept $4. That's why a lot of small businesses don't like credit cards. Or if they do use credit cards, they charge their customers more if they use a credit card because they have to pay for the fee. Anybody ever been to a gas station and they have one price per gallon if you pay in cash or a debit card, and they have one price per gallon if you use a credit card? And the price per gallon for the credit card is more expensive because they have to collect a fee. They have to pay a fee. Where a debit card or cash, they get the money immediately. No fee. You have to account for this in your business. And you have to account for these fees when you record a sale. Now, I was talking earlier about writing off bad debt. Spend a little time looking at this in your text this week. People do not pay their bills. The fact of life. And I gave you some reasons a little bit earlier. People do not pay their bills. So we have to, as accountants, we have to account for that. There are two methods for accounting for bad debts. Two methods. Accounting always has to make things complicated. You can use the direct write-off method, or you can use the allowance method. You need to be familiar with both of these methods. The direct write-off method is to take an amount and write it off for the exact amount of the credit, the receivable. The allowance method is to take a general allowance, not a specific amount, but an anticipation of bad debt and writing it off. And I'll explain that to you. Here's the direct write-off method. TechCom determines on January 23 that it cannot collect $500 owed to it by customer J. Kent. Notice the specific customer. So the direct write-off method is to debit bad debt expense for $520 and credit accounts receivable, J. Kent, $500. You're directly writing off Mr. Kent's account. He's not going to pay you. You wipe out the receivable and put it into bad debts. Now, you might ask the question, hey, what happens if down the road Mr. Kent decides to pay you? Well, you just have to open up the account again by debiting accounts receivable $520 and crediting bad debt expense, wiping out that bad debt, and then record the cash being received as a debit and crediting accounts receivable. You just have to reopen the account up. But the bad debt expense is called the direct write-off. You're specifically writing off a specific customer. But then we have what is called the allowance method. And it's not a direct write-off. And this is what it is. Now, be honest with you, This is what 80% of companies do, the allowance method. At the end of each period, usually a fiscal year, they estimate the total bad debts expected to be realized from the period's or the year's sales. They estimate bad debt. They do not know exactly who's going to be bad debt, but they estimate it every year. There are two advantages to this, and this is why companies use it. It records estimated bad debt expense in the period when the related sales are recorded. In other words, you expense the bad debt in the same year that the sales were. That transaction, that direct write-off method that we just looked at for Mr. Kent, that sale could have been in a prior accounting period. So we're kind of recording the bad debt in another year different from when the sale was made. Not as clean. Here in the allowance method, we're recording the bad debt expense based on an estimate in the year that the sale occurred. That is huge. That's why, ladies and gentlemen, it's only ladies tonight. You are only to be responsible for the allowance method of recording bad debt. Do not worry about the direct write-off method. You are to be worried about the allowance method. Also, another advantage is of using the allowance method. It reports accounts receivable on the balance sheet at the estimated amount of cash to be collected. In other words, you're telling the world this is what we think we're going to collect, but also this is what we think we're not going to collect. And you'll see that in just a minute. Here's how this works. TechCom had credit sales of $300,000 during its first year of operations. So they had $300,000 of billed sales. At the end of the first year, $20,000 of credit sales remained uncollected. So at the end of the year, they had an accounts receivable balance of $20,000. Based on the experience of this company, they estimate that $1,500 of this accounts receivable will never be collected. They estimate that. Now, is this a good estimation? Yes, and here's why. Your public accountants, your CPA firm, your independent third party will review and make sure this is legitimate. A lot of times companies hide money by estimating uncollectibles. So their public accounting firm has to make sure that's correct. So the public accounting firm reviews the TechCom $300,000 sales, of which there's still $20,000, and look what the journal entry is. This is an entry for the allowance method. Notice you still debit bad debt expense. In this case, it's $1,500. But notice what we're crediting. We're not crediting accounts receivable. We're crediting allowance for doubtful accounts, $1,500. And so notice if we post those to the ledger, we still have the $20,000 that has yet to be collected in our accounts receivable balance. At the same time, we're showing the world that we estimate and have allowed for $1,500 as a credit balance in this asset account called allowance for doubtful accounts. So our net receivables are $18,500. But the person or the people who are looking at our financials will see, oh, they're owed $20,000 and they've set aside or estimated $1,500 of that for uncollectible. That's why most companies do it this way. They leave, even that you might never get this money in accounts receivable, and you allow or estimate that. And that's the journal entry. That's the adjusting journal entry to adjust that for the year. That's the method you need to be familiar with. This slide here, taken from your text, the allowance method for recording bad debt expense. And again, a lot of you are saying, what the freak am I doing this for? Again, a lot of you will never do this entry. But if you're in the management of a company, or if you own a business, one of the first questions your investors or your bankers will ask you is your cash reconciled? Yes. How much do you estimate as bad debt for your business? Huh? What are you talking about? Yeah. How much are you estimating you will never collect of your receivables? $1,500. Okay, thank you. Those are things that investors, bankers, and people always ask. Is your cash reconciled? And also, are you allowing for bad debts? You cannot assume, unless you're Don Corleone, that you're going to collect all your receivables. It just doesn't happen. And here's how that looks on the balance sheet. Under current assets, accounts receivable, $20,000, less the allowance for doubtful accounts, $1,500. You have a total net receivable of $18,500. So you're properly showing that. So the bad debt still is on the books. But at the same time, you are allowing money to be set aside. Now let's say somebody, that Mr. Kent, remember I said earlier, Mr. Kent, let's say we set that money aside as an estimate of bad debt. Well, if all of a sudden he pays us $520 to help restore the credit standing, a customer sometimes pays all or part of the amount owed on an account even after it has been written off. So we set that aside and we credit. The original entry on March 11th was to open up the receivable again, take it out of allowance for doubtful accounts, record the cash, and take it out of receivable. Now, how did they estimate that $1,500 in that last problem? How did they estimate that of a $20,000 receivable, $1,500 is not going to be collected? There's two methods. The percent of sales method or the accounts receivable method, which is based on an aging of accounts receivable. Some of you might be familiar with an aging list. Of our total accounts receivable, how much is outstanding? Current, 30 days, 60 days, 90 days, 120 days. And usually after 120 days, you might estimate that might never be received. So these are two methods you need to be familiar with. And what is the percent of sales method? Bad debt is computed as a percent of period sales. 1% of period sales is uncollectible. It's based on a percent, and that percent could be based on history. We usually don't collect 1% or whatever. So here's an example. Musicland had credit sales of $400,000 in 2017. It's estimated that 0.6% of those sales will be uncollectible. 6.6% of 400,000 is $2,400. Debit bad debt expense, credit the allowance for doubtful account. Notice we're not touching accounts receivable. We're saying that 0.6% of our outstanding receivable will not be collected, and we're setting it aside. That's called the percent of sales method. Basically the easiest way of doing it, but most companies don't do it this way. They do it the aging list, and we'll see that in just a minute. In other words, based on our company's history of collections, it's on average, we don't collect 0.6%. That's a pretty good percentage. Again, it depends on the business you're in too, of what this percentage would be. And here is the aging list of that company. Let me make this a little bit bigger here. There we go. Remember, the percent of sales method just took our total sales, credited sales, and took a percent of it. But here, notice we have a total receivable balance of $50,000 from these 1, 2, 3, 4, 5, 6 customers on December 31st. They owe us $50,000. $740 of that, excuse me, $37,000 of that right here is not due. It's current. We just billed them. $6,500 of that is 1 to 30 days past due. In other words, it was, let's say these sales are current, so they were billed out in December. These are due in January, $6,500. 31 to 60 days, $3,700. 61 to 90 days, $1,900. Over 90 days, $900. And then the company has determined that each one of these types of aging amounts or days, 2% will be uncollected, 5%, 10%, 25%, and 40% of anything over 90 days, our history says we will never collect. You do the arithmetic, and your entry is to debit bad debt expense. Oh, but wait a minute. Let me go back. In other words, based on these percentages, we're going to have an uncollectible estimate of $2,270 at the end of December 2019. But I already had a $200 credit balance in my allowance for a doubtful account at the end of December. So if my balance needs to be $2,270, all I have to do is adjust $20,070 debit bad debt expense credit allowance, and now I have a balance in my allowance account that's equal to my aging calculation here. I used to do this for my business. Every December 31st, I did an aging list. Then I had my CPA look at my percentages of uncollectability. And then I did this journal entry, adjusting my allowance account. Oh, I still had $200 that I have yet to expense or write off. So I add the difference, $2,070, to get to the $2,270 aging list amount, and that's my adjusting entry at the year end. Always make sure you understand what the prior balance is before you make that adjustment based on the aging list calculation. People do this for a living and get paid very well for it. Why? They're managing the collectibles of a company. A lot of people pay big money to people who can collect money, accounts receivable managers. This is one of those reasons. So let's review it. We have two methods of writing off bad debt: the direct write-off and the allowance method. You're going to be responsible for the allowance method. And then there's two ways of determining that allowance amount: percent of sales and aging. Both of those you'll need to be familiar with: the percent of sales method and the aging. And there's a problem that I'd like you to practice that does this, and it's on page 351 of your text, problem 9.1a. What I would like you to do is I would like you to now take a few moments, look at problem 9-1a on page 351, and see if you can do the journal entries for those transactions of June 4th to June 18th. This shouldn't take you too long. Let's try to record those entries, and I will do it on my Ouija page here. But you take a few moments and you try to do those entries on page 351 to record the resale of merchandise on account, and then the writing off of those charges into an allowance for doubtful account. So let's do that. Let's see if you all can do that. So I'm going to shut up. Thank God. And I ask you to take a few moments. Barbara, I'm watching you. So if you don't do this, I'm going to be upset. So Barbara,
I'm pulling up my ebook. Sorry, it's because I have it on. I don't have an actual book. I just have an ebook.
it's okay, Barbara. But you can get out a piece of paper and you can do this. There you go. Okay. You don't have to prove it to me. I'm just joshing you. So let's take a few moments and everybody look at page 351 of your text and try to do those journal entries from June 4th to June 18th. And I'll come back to you all in about 15 and 20 minutes. And I'm going to do this on my spreadsheet at a very slow pace so you can check your answers as you move along. Ready? Set? On your marks? Get set? Go. 9-1A. Begin. This is not for a grade, so don't anybody worry about it. Okay, a couple different things here. First one is notice how we handled the credit card sale. We had to take into account the credit card expense. In this case, it was 3%, and another one, it was 2%, and the other two were 2%. So we take out the credit card fee and receive the cash and still record the sale at the sale amount, but the credit card expense is going to be an expense of that sale as a regular expense account in my general ledger. And a couple interesting thing down, and notice we have to record the cost of goods sold. We know about that. And the second thing to note is the June 13th transaction, where we're writing off Mr. McKee account of $429. And the reason for that, we're debiting the allowance and crediting the accounts receivable, is because it says that this was a credit sale last year, not the current year. We've already allowed for that bad debt expense in a prior period. So now we're taking that direct write-off of Mr. McKee's account, crediting accounts receivable, and charging or debiting the allowance account because we've already set that money aside last year. Now, if they would ask us to do an entry to record this year, then we would use bad debt expense and credit the allowance to estimate bad debt this year. But since Mr. McKee was an account of a prior year, the write-off is a debit allowance and credit a receivable. This is the allowance direct method. Now, what I would like you all to do as some work over this next few days is I'd like you to do the following two problems. You don't have to do them. It's not for a grade, but it's to prepare you for next week. I will post the answers this weekend to these problems so you can check yourself or just use that as a study guide. The problems are problem 8.4b on page 321. 8.4b on page 321 and 9.2a on page 351. 9.2a on page 351. I'd like you to do those two problems. The 8.4b is exactly what we did in the reconciliation problem in 8.4, but I'd like you to do it yourself. And problem 9.2a is going one step further in this bad debt expense allowance method, is to actually record the adjusting entries to record bad debts based on the information given to you. Also, I'd like you to do right below that 9.3a. The difference between 9.2a and 9.3a is that 9.2a is a percent of sales method and 9.3a is based on an aging list. So I'd like you to practice those problems this week. I will post the solutions this weekend and we will talk about it in class next Monday. And you also will have a quiz on that next Monday. Any questions? Okay. So that's our work for tonight. Pretty good. A bank reconciliation and accounts receivable entries. We've looked at problems 8.4a and 9-1. And I would like you all to look at 8.4b, 9.2a, and 9.3a as practice of this to get you ready for next week. So a light week. You guys have worked hard enough on that midterm, and I'm sure a lot of you are going nuts over that one. So let's do this for next week. And then next week, we're going to talk about your project paper. You might want to take a look at that sample paper that I gave you in Blackboard. And next week, you're going to look at chapters 10, 11, and 13. Get out a pen and a piece of paper. I'm going to tell you which parts of those chapters I want you to concentrate on. That'll be part of my lecture next week from chapters 10, 11, and 13. I'd like you to read in chapter 10 from page 359 and learn about or read about depreciation methods. 359 to 366. 7 pages. That's not too bad. In chapter 11, I want you to read about liabilities. Kind of like what we did tonight in our receivables, but this has to do with money that we owe. How do we record when we can't make a payment on liabilities? That happens. That's happening a lot these days. Trust me. So I want you to read page 397 to page 406. 397 to 406. And then finally, we're not even worrying about chapter 12. We're going on to chapter 13. How do we account for corporations? What's the difference in accounting for corporations? Well, 2 words, stock and dividends. Chapter 13 is accounting for corporations. I want you to read from page 465 to page 475. So just those segments of those chapters, of those 3 chapters for next week. 359 to 366, 397 to 406, 465 to 475, and I'll put these in Blackboard when I post the spreadsheet file of our work tonight, and I'll post these pages for you. So no graded work this week, just practice. Graded work next week with the quiz. I hope you're all doing fine. I worry about you. I worry about you because I never can see Barbara or Marianne or Tori or Gabriella. All I see is Barbara. And that's lovely in itself. But at the same time, I need to see everybody else. But I also understand why I'm not seeing you all. So don't anybody get all hyper. All right, guys, I'm going to cut you loose. It's almost 8 o'clock. Good work tonight. Study these this week. Some of you still have to post your midterm. Get that in as soon as you can, but take your time. Make sure it's done correctly. I'll post those grades this coming weekend. 4 more weeks left. 4 more weeks. Oh, by the way, I have an announcement to make. Maybe some of you guys don't know this, but this weekend I was told that I'm teaching the Business 330 course, Business Finance, this summer for Burbank. Many of you, that's the next class that some of you need to take. Business 330, I will be teaching that, sorry, but online, but still I'll be teaching that this summer for any students who want to take that class and have me, the dopey professor, Mr. Hassey. So
what day are you going to be teaching? Is it all going to be online? Is it going to be like this with the WebEx?
It's going to be just like this, but I'm going to designate a day. And I think I've already done that. I think I've already told Susan Lamelli that. Hang on, let me get that designated day. Just a sec. But that day is optional. I mean, I can adjust it based on the students. So let me bring up that day. Hope you guys can't see this. Here's the day. That day for that class, as of now, is going to be Tuesdays from 6 to 9. Tuesdays from 6 to 9. Now that can change if you guys need it. And I told Susan Lamelli I'm planning on Tuesdays, but that can be changed based on your guys' needs in the class. Right now, I think she has 16 students in that class for Business 330. and I'm planning on having a lecture just like this. We have it on Monday night. I'll plan to do that class on Tuesday night. Questions?
Real quick, Professor, this is Tori.
Yeah.
Does the business 330 conflict at all with the management 360? Do you know offhand?
I do not know that. I think Susan was trying to work with the other professor on that and see what day he or she wanted. And if it's a conflict, Tori, I will change. I will adjust. All right. I will make it can be changed to any other day. The only other day I'm committed in the summer right now is Wednesdays. But it could be Monday, it could be Thursday. But I'd like it to be Tuesday. It fits into my flow. But at the same time, it can be changed. So if there's a conflict, we will change that. So don't worry about it.
Professor,
Thank you.
I'm sorry.
Go ahead, Barbara.
Okay. I haven't taken a statistics, so is it a possibility that I could take finance and a statistics at the same time?
Yes, there is. That's been done before. You need to check with Susan Lamelli or your advisor over at Burbank about that. But Barbara, it's going to be a lot of work.
I know. Yes, but I'm done this. I got 2 terms to go, so I need to pull through.
And if you have a good professor in the statistics, you can manage it. You'll just have to do a little bit, some work. But I think that can be arranged. And again, talk to Susan Lamelli and your academic advisor about that. Okay.
All righty, perfect. Thank you.
All right. So I think for some of you, this is pretty decent news. At least you know a professor that you might have for this class, which is me, even though I'm kind of dopey. But at the same time, I just found out about that this weekend. And that's the plan, is for me this summer to teach the 330 class for the Burbank students. Okay, so going forward, any questions on that, check with your advisor or Susan Lamelli.
Professor, I'm sorry, one more thing. If I'm able to get permission to take the class, I don't think I could do it on Wednesday. No, what day did Tuesday? Because
Tuesday.
I'm also taking communications class, I believe.
Okay, well, let's see how that works out. Now, remember, Barbara, if you're the only student that has that problem, what we'll probably do is have it on Tuesday, and I record every class, so you can do it that way. And I'm going to have office hours. My class is going to be Tuesday. I'm going to be having office hours Thursday, either in the afternoon or evening, and you can come and see me then there, and we can go over the recording thing. So we'll work around that, but if we have more than 2 students, I'll change the date.
Perfect. Thank you, Professor.
Okay.
Appreciate
All
it.
right. Okay, any other questions on that? All right, that's good. So I think the schedule is pretty well set now for the summer. So check with your advisor, make sure you know what's going on there, and make sure you can work your schedule around all that. All right, everybody, you have some work to do this week, but the good thing about it, it's not for a grade, it's practice. And we'll see you all next Monday. Have a good, safe week and stay cool. It's going to be hot. Stay cool this week and enjoy yourselves. Thanks, everybody. Adios.
Thanks, Professor.
Bye-bye.
Bye.